What's up, guys? Mike Sharp here. This is Sharp Investing, and this is Vistry first half review, and I want to go over the thesis and some other things that I want to talk about. Going to try and do this one quick, but I'm not usually good at that. So anyway, I think that this might be the market being extremely wrong about this one. I'm pretty confident that the market is not able to see past the end of its nose, and there is a massive mispricing here in this stock. I do think the last earnings release was quite good. The messaging was quite good, and the market took it as negative. And the last time I saw that situation where the stock I owned was flow, and that was maybe a bit more than a year ago. I think I titled it, the price down on good news. And I think this is maybe another one of those situations. Even though the price didn't go down, the noise around these earnings were pretty bad in terms of like the analysts and people just looking at the numbers pretty quickly. So I'll go into why I think this is looking quite good for 2026. But first, let's just review the thesis a little bit in short form. So Vistry is a asset light home builder that focuses on partnerships with housing associations and like local governments. So they partner together. The governments a lot of the time will provide the land and the permitting and stuff like that. And those are things that traditional home builders kind of they get stuck on, right? Because they have to fund with their own capital land purchases and work in progress. They have to fund it all with their own capital. So there's only a certain amount of building they can actually do. And they take on a lot of risk there too, because then they get paid when the thing gets sold, and they don't actually know when that's going to be. If there's a housing collapse between now and then, they can really get hammered, right? So Vistry is very light in terms of the assets that they need to put up to do a lot of these builds with these government operations, and so it allows them to build a lot more houses in the same amount of time. They also have a thing called Vistry Works, which is like their prefab factory, so they can build a lot of these houses even quicker because they're just sort of like cookie cuttering, a lot of these builds, right? They've reduced the number of models that they can build, right? So they're getting quicker at building this stuff, and they have a cost advantage in that sense as well. So this is a very interesting business, and also because you're building for the government, you're not as dependent on the economy, right? Because some of these governments are agnostic in terms of what's going on. They just, they need to build when they need to build, and it's not like the private sector that will go into as much of a sort of contraction when the economy gets bad. Now, keep in mind, this is actually, I think the housing sector is in a contraction in the UK for maybe a couple of years now. And so if you've ever said to yourself, I'll buy when the crash happens, right? I'll buy when the crash happens. And every investor I've ever met, including myself, says that. We said, okay, when the crash happens, I'll buy again. You look at the chart, the crash happens, you go, oh, I should have bought there. That was great. But let me ask you a question. What did you do in the Trump crash in April? Did you buy, or did you sell, or did you do nothing? Because that was the crash. But I was getting to something with Vistry. If we look at the chart of Vistry, that's the crash. The crash is here, right? This thing fell, okay, let me look. Boom, from top to bottom, 63%, right to the bottom, 65%. That's the crash, right? So we're not looking for a market crash. We've had this in the stock that we like, and this has created a huge opportunity, right? The company had cost overruns in 2024, which were temporary, and they're getting past them already, but the market treated it like it was this permanent injury to the business, and I don't think it is, right? Maybe the reputation of the management was injured, but that can be repaired by making money, right? So still doing the review of the idea. The main thing here is earnings, right? Their medium-term earnings target for operating income is 800 million. We don't know exactly when that is, but let's say it's 5, maybe 7 years. 800 million for a company that's trading at 2 billion market cap. Like, that's a pretty good risk-reward scenario, right? If you believe that they're going to get there. Even if they get to 500 million, that's still put them at least 5 billion in market cap, probably 6 or 7 actually, because what you'll have is you'll have this inflection point where the market goes, oh, they're actually making money again and they're growing, and that will attract a larger multiple than they're trading at right now. And I'll show you how low it is at the moment when we get to it. The tailwind for them is that there is a massive housing shortage in the UK, millions of homes, and the Labour government that's just got in has promised to build 1.5 million homes over 5 years. That's 300K per year, and that is way higher than than has been built in the country for a long time, right? So this is pretty ambitious. They might not get there, but the point is that's their platform. That's what they were running on, and they have to deliver. Like you hear in the back rooms, the people at Vistry, the government's telling them, just build, baby, build. That's what they're telling them. Just build, right? And if we look at the size of Vistry, they're about 5 times as big as the next biggest competitor who does these, who's able to build these low-income social housing projects. And if the government's going to get to their target, they need Vistry, right? I've actually heard it said that the government needs Vistry more than Vistry needs the government. I don't think that that's necessarily true. It's a nice soundbite, but they need each other, right? The government needs Vistry. That this is their main lever to pull to get to those targets, right? So you have these huge tailwinds, and I'll go into that one a little bit more here because there's a big win that's happened since I did the first video. Like I said, they're moving to an asset-light model over time, moving away from the more asset-heavy building, and the goal is to get to 40% return on capital employed and 12% margins. Now that's different from a traditional builder, which will have a lower return on capital but higher margins to make up for the risk that they're taking. And then the bonus on top of that is their goal is to release $1 billion from the balance sheet. So they have as they go more and more towards this asset light model, they can release land, and the work in progress goes down off the balance sheet, and that's capital that's turned into cash that they can return to us shareholders. And their goal is to return $1 billion in buybacks over time. Again, if you look at the $2 billion market cap right now, like that's a pretty big chunk of the market cap. They currently have a buyback program on, and I think it's 125 million. So they're going slowly right now, but this will ramp up as they make this transition, right? The speed of this will probably ramp up, and as soon as they get their debt down to a certain level, right now they're paying debt down with some of the extra capital. But once they get the capital down and the earnings go up, which I think all of that can inflect in 2026, the buybacks can go up quite a bit going forward, right? So they buy 1 billion shares or $1 billion or £1 billion back in shares. Either the stock stays where it is and we get a double in our EPS, or the stock reacts to that and maybe it doubles just from the buyback, or more, right? As the market sees that they're pretty serious about these buybacks. So some really good tailwinds here. Now they can still do badly if the market does badly. They're a little bit more insulated, like I said, from the cycles of the economy, but I do still think that they're interest rate dependent. It's still expensive for the government to borrow to fund these projects at these higher rates. So if we see an increase in inflation in the UK, they kind of seem stagflationary right now, which is a little bit concerning. But if inflation stays high, it's going to be hard for the government to push down the borrowing costs and rates. Okay, let's go over the Q2 items that I think are important. Now, there's a whole bunch in this. They give you a lot of information, which is really nice. They're very good about giving us investors a lot of information. I even sent them an email just tongue in cheek saying you need to buy back some more shares while the price is cheap, and I did get a reply. Right, it wasn't even a professional email. I just sent them one bugging them. I actually sent it to Greg, and I got a reply, not from him, but from his secretary. But anyway, so in Q2, the big news here in the first half was in June that the government committed $39 billion to affordable housing over the next 10 years. This is a huge amount, unprecedented, as they say. And this gives Vistry a revenue tailwind for 10 years now, right? So if you want some stability in your investments, that's a pretty good runway that they've given us here. And that is almost double the rate that the previous government was spending on this. They spent $11 billion in 5 years, which is just over $2 billion a year. Now it's going up to almost $4 billion. So this is right in Vistry's wheelhouse, because like I said, they're the only ones who can really do affordable housing at scale at the moment, right? So this can really juice their growth rates over the next few years. Now, what's happened in the first half? The first half wasn't great because, well, I'll get into the numbers, but basically there was a lot of waiting, right? In the first half, everyone was waiting to see what this government budget would look like on housing, and so the sector was a little bit frozen, right? So the revenue went down 6%, operating income went down 23%, and this is just due to sort of like a freezing of the sector. And now what's happened is the funding has been approved, and now it's go time, right? So the company is saying in 2026 we should see a real inflection upward in terms of the revenue and the profitability, right? So that's why I think the market has got this totally wrong. They're seeing about this far, like maybe by the end of the year it's not great, but I think if we look a year from now, this is going to seem like a silly price to selling at what, $637 at the moment. So like I said, operating profit, $124 million for the first half, down 23%. Units were down 12%. Again, this is the same, everyone just waiting for the announcement. And also they had some lower margin projects which were rolling off based on like those cost overruns they had last year. So those had to roll off and get off the books. And they're basically, they're done now. So that problem last year that crashed the stock is basically gone now. And the stock has not recovered. All right, the company knew this was going to happen. These earnings were not a surprise. They said this is expected. This is right in line with what we thought were going to happen, and it's fine. But the big thing for me is they're on track. They say they're on track to beat 2025 earnings, right? So if you do the math here, that means that, well, last year's operating profit was $358 million, which means the second half is going to be at least $234 million, right? Which is about double what they did in the first half. So let me ask you a question. You think the market's going to like that when they release that number? I would bet yes, right? So if we look at the valuation right now, they're trading at only 5.8 times 2024 operating profit, right? That seems extremely low for a company that's set up for a fairly big chunk of growth on the way. In a pretty good industry, actually. Like, I mean, AI is not going to kill our need to live in houses, right? This is a pretty stable industry, right? Other things to talk about on Q2 first half was the rent convergence. And so what this means is that housing associations were kind of locked into whatever rates that they were able to charge their tenants on this social housing before. And now the government said, actually, you can raise some of those at a certain level. You can raise them at CPI plus 1%. And then in some scenarios, there's this big discrepancy in what people were paying, right? So what they said was they had allowed to bring up the ones that were low and sort of get all these social housing rents on the same level. And that's really good for these housing associations, because now they're going to have more revenue that they can plow back into building more units, right? Whereas before they were kind of stuck with whatever the rents were. So that's a really good one. The company was quite excited about that. Net debt, yeah, like that one's down I think it was 30 million this quarter, which was better, ahead of their target. I'm not too concerned about this one. I kind of wish that they would do the buyback instead, but I think they're just being prudent. They want to make the balance sheet look really good before they do the buybacks. Whereas my argument is you should actually be borrowing to do the buyback at this level, right? Like you should, at $6.30 per share, like, man, you should be buying back a lot. But anyway, I'm not going to get my way. I'm maybe a bit more aggressive than they are, and maybe that's what we want. We want a more conservative home builder that's not going to try and juice the returns by doing leverage buybacks. Another thing I wanted to mention was they have 58,000 homes contracted already, right? So that's almost 3 years worth of volume that's already been contracted, and that's a pretty good pipeline, right? Basically, they're saying, you know, we're full. We've got all the projects we need. We just kind of need to do them now, right? 88% of them for this year are forward sold. That's great. And then the upside here is if the open market, say, portion of the portfolio picks up, which has been the drag on the economy and this housing sector, right? If that picks up at some point, maybe they're able to drop rates another 5% or something, and it sort of re-energizes the sector. That would be a bonus, right? Because right now we're kind of expecting it just to suck like it's been sucking for the last 2 years. Like I said, housing's kind of in a recession right now. If you like, and back to the other point, if you wanted to buy in a recession, this is it. So bottom line, this is a cheap business, the way I'm looking at it, based on future earnings potential. And I think the inflection is coming, and I think the market sentiment is going to inflect as well. And this thing could end up with a rocket up its ass. The team at the earnings call was extremely excited. You could tell they were very upbeat, and that really they really thought that the future was looking bright. So my position, I have a big holding of this company, and I'm just going to hold, and I'm going to close my eyes and wait. Thanks for watching, guys. Catch you in the next video.